Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for November 20th, 2016. Market is in bullish normal conditions on an annual basis using weekly RSI 14. We are at the higher end of neutral at 60 out of 100. On a 10-day basis using the 10-day NDX, we are overbought at 93 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is white bullish at 4.86. The slope of the 50 has improved to yellow neutral at positive 0.11. The ADX is strongly bullish at 27.7 in terms of recent trend. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. We're at 1.099, so we are in risk on right now. When we compare that to the last 5,000 trading days, find the average and standard deviation. That lets us compute the risk Z, which is currently at 1.04. Here you see a 90-day histogram of that indicator where we've come down and bottomed out at almost 2 sigma below the long-term average and have now had a positive move up to +1 sigma. When it upturns like this is when we're looking to begin exploiting some momentum to the upside as volatility declines, which has been a good play the past week or so since the election. These are the winning holdings in the blended monthly rebalancing, which are due to be reevaluated on or about 1 December. These are the current leaders in the various ETF portfolios, along with some key momentum leaders in these portfolios as well. ETF2 remains at 40% exposed in the theoretical model, and the model portfolio itself remains at 40%. Here's a quick look at a couple of the ETF portfolios for BMR. All the U.S. in the green, along with Japan, everything else still below average. So you can see the shift has come back to the U.S. as the election has been resolved. The ETF 32 looks similar, with strength in financials and industrials and technology to supplement the small caps. ETF Max looks at 1,000 ETFs using the same lens, and things that jump out at me that I like to look for additional follow through for swing trading and even on some day trading for that matter are things that have been extremely strong on the blend in the green and then have had extreme 1 week moves as signaled either by red or green. So coal, for example, has had a tremendous run over the last 6 months, but the last 1 month, 1 week has featured a pullback. Well, that's one that seems like a reasonable target to be stalking because of the Trump win. So we'll be taking a look at the perhaps opportunity established by an almost 5% sell-off this week. Regional banks, Global Carbon, has had a decent 6 month, a great 3 month, and then has been on a tear this past week. So there's a possibility for an additional momentum follow through this week. Semiconductors, select microcaps, more semis, information technology. These are all things that are greens across the board, so I look for continuation of momentum there. And then the ones that are in the red in this column, I look for possibility of buying momentum on a dip, or this may be a point where that market has cracked after a parabolic move up, and it may be on a race back to fair value. So I like to look at this 1 week supported by the 1 month lens to give me insights into how these relative strength leaders are performing. I like to find the extremes and then work with those. Same logic with the S&P 500. These are the top 40 or so. So things like NVIDIA, United Airlines, Micron, Best Buy. these really are taking off in this past week, and so there's opportunities to get short-term bursts as people discover or reinforce their positions in these relative strength leaders. So we can use the blended monthly rebalancing not only as a guide towards our longer-term portfolio positions, but also as a way to get insights into shorter swing trade and short-term trading opportunities as well. Taking a look at the market health check now, you see this rocketing upward move of the last 10 days based on the surprise victory in the presidential election after that sharp sell-off down to Z3. This has cleared that previous resistance level at 217, 218, barely, but now we'll see if there's any follow-through or whether that was sort of the relief rally, if you will. Support levels still on the downside. If this were to collapse, I would think that 217 has or the edge of the river, Bollinger Band mean, but the real support level to me is this double right here at 213, down around the belly of the dragon around 211, and then really the sell-off down here to 208. But this looks pretty robust, and I would think that weakness here would be seen as buy on dip opportunities. If it can stay above the hump of this dragon here at 217, then this is a base that is building for the long term. The slope of the 30 is positive. The slope of the 10 is extremely positive. We've been oversold for 10 days. Jaws of PPO are still open to the upside. So this is a market that has some strength and may be getting stronger. In the ETF2 lens, only the U.S. symbols are on a buy signal that puts us at 40.60. In the theoretical model, the S&P at 49 is better than the EFA at 41. Inside the U.S., it's small caps, mid caps, tech, then the large caps. Two strongest sectors are small caps and mid caps, and then the two weakest sectors are emerging markets in the European 350. Brazil and Latin America pulled way back into the pack. See here, U.S. financials are the source of strength here in the market. U.S. or the world market model. World market model, starting with the U.S., all small caps, and then the mid cap value extremely above average, and then all the U.S. above average. Mixed bag in Asia, but generally below average. Only Hong Kong and Taiwan and Japan stand out. Latin America has fallen below average. Brazil still above average. Mexico really suffering, not surprisingly. I think that's an overreaction, and I'm watching and trading the peso intraday to look for recoveries there. Global financials have been strong. Europe is a mixed bag, but mostly weak. ETF top 30, regional banks, semis, Japan total dividend, Tech 100 and biotech, and then some of the emerging strength here, green and white, Goldman Sachs, metals and mining in the Dow 30. Morgan, Caterpillar, Boeing, Microsoft, American Express, the top 5. Weakness down here in Verizon, Coke, Pfizer, Nike. I would be looking for some interesting potential moves in the pharmaceuticals now. I think they've been depressed for almost a year on the concerns about a Clinton victory. So there's plenty of room for those things to come back to a fair value. So that's kind of a long-term stalking. I'd be looking at Merck as a leader, along with United Healthcare, already in the top half of the Dow. Shifting to the daily report now. Some channeling signals here in Asia, less Japan, and Latin America. Plenty of swing setups from channeling, overreaction, the 5 DDs. There's Pfizer and United Health that look to be interesting. a 55W in Walmart, and then still lots to choose from here in the auto framer. Dow 30 Tactical, lots of dojis on Friday. They were willing to carry that into the weekend, and some still really good-looking auto framer reward to risk ratios here. Procter and Gamble really comes to mind as an overreaction. Oh, I'm sorry, that's Cisco, but at 3.8 to 1, and then a big loser on Friday. I just think that has some potential. 5 DDs here: United Health, Pfizer, and United Tech. Inside the ETF 30, same kind of lens, not many pattern signals, except you got a couple of the channelings here. And then still a handful of RSI2s firing. And then big day in Brazil. This may be a recovery after that kind of sharp sell-off. In the auto framer, some key price levels noted here. And then in the regression line, fractal framework, top shelf are the deep value plays, the ones that are the most ATRs below their own 270 regression line. And the bottom shelf are the ones that are overheated in the red. That's how many ATRs above their long-term fair value they are. So the bottom shelf, I say overheated, but really that's relative strength momentum, and so they can be framed in both directions, as can these. What we're really looking for are the extremes on both ends of relative performance compared to their long-term. These are the ones that have the biggest difference of opinion in between the long-term holders, position traders, and the shorter-term traders. So there's some built-in action on this. And then the daily squeezes, these are the ones that are postured for one-day pops that if they break out of the previous day's high or low, the potential for a large move is there, just if it moves to a range stat. And this tells you the relative reward to risk ratio between a range stat and the daily range that they turned in on Friday. So that means they had to be volatile enough to be useful as on the range stat, but then a tightly compressed on Friday, so you get that coiled spring effect. And what's interesting here is you have diamonds, the DIA, Dow 30, the S&P itself, the small caps. So the market itself is postured for this kind of expanding spring-like action. Just quick look here at the market mosaic. Price leveling out here around 219. We're back to the long-term average in terms of the slope of the RL30. The RL30 crossed its 10-period moving average back here. Gave a signal for a shift in a change in direction of trend, which you see then follows through nicely. So this is one of the key things I look at every day is the slope stat of the 30. When it has moved outside more than one standard deviation below or above the black line, the long-term average, and then reverses direction and crosses its 10-period moving average, I take those as potential turning points, which is what we see here. Nice rebound here on the percent stretch relative to the 200-day moving average, sort of restored that what was an aging bull. Just flash through these quickly. You can stop the tape or look at the charts in the report if you need them. The Swing Z scores, the ones that look interesting, again, Microsoft, financials, but really it's these in here, the U.S. Indexes, the Russell 2000, mid-caps, and the S&P all in the positive territory, a sign of real strength coming back to the U.S. The 10-period slope stat, almost 2.5 Z has come back. The 30 has crossed the zero line, is now still in the channel though. The 90 has reversed and resumed its upward slope. And so when you get these kinds of moves, when it turns after almost a 2 sigma drop off, these are the kinds of moves where you can get some traction. The last time I did that was here, so you had a nice move from about 210 up here to a peak around 219. So there's a potential for some more follow through on the basis of this change in the long term slope stats trend. All right, that's everything I wanted to cover for this weekend. This is Ken Long at Tortoise Capital. Keep your risk measured and your powder dry.